From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the latest payrolls report coming in weaker than expected, leading investors to question if the Fed is too slow to cut rates, and sends Treasury yields falling across the curve. And we caught up earlier today with Mohamed El-Erian following that jobs report.
Growth scare, policy mistake. That is what I'm hearing. That is what you're seeing from the price action. I think the market now fully understands that the Fed may be late.
Taking a look here at world interest rate probabilities, WIRP Go on the terminal. Remember, economists at almost every major bank recalibrated their forecast for the year after that jobs data. Citigroup economists now expecting a half-point rate cut in September and November and another quarter point in December. JP Morgan believing a rate cut could come even sooner than that next September meeting. Flip up the board here, too, because in addition to the swaps markets, you have the spot market moving drastically. That two-year yield dropping more than 44 basis points this week and 20 today alone. Just a drastic move over the week that you haven't seen since the SVB collapse. And live now on Bloomberg Television and radio, I am Sonali Basak. Joining us now is Bloomberg's Michael McKee and Chicago Fed President Austan Goolsbee. Mike, get us started.
Thank you, Sonali, and thank you to everybody who is watching us around the world, including Austan Goolsbee joining us from Chicago. Thank you very much, Mr. President. Hiring dropped precipitously. The unemployment rate shoots up more than anticipated. Everyone wants to know, did the Fed make a mistake by not cutting rates on Wednesday?
Well, look, you know I'm not going to get myself in trouble and talk about what people's thinking are from the meeting. You're going to have to wait for the transcript to come out to see what was on people's mind. I've been saying to you, Mike, for a long time and publicly that we'd never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, you know that the market said maybe there would be 7 cuts for the year. And then when a month would come in, then that 7 would drop to 3. Then there was a group saying maybe there will be an increase in rates. The job of the central bank is to figure out the through line and to move in a steady way. I've been warning that we are tight, we are restrictive. The real Fed funds rate is as high as it's been in decades. And as inflation falls, that gets tighter. If we stay restrictive for too long, we're going to have to think about the employment side of the mandate. And if you look here, if you take this summary, the statement of economic projections in the SEP, the neutral rate of inflation, the long-term rate of inflation and unemployment, say that people think full employment is about 4.1%. So if unemployment is going to go up higher than the neutral rate, that is exactly the kind of pinching on the other side of the mandate that the law says the Fed has to think about and respond to.
Well, you've been talking about a rate cut, yet you voted to keep rates unchanged. Why did you do that? And now do you think maybe you are behind the curve?
Well, look, like I say, I'm not going to get into talking about the secret discussion. You got to wait for the minutes and the transcript to come out. I was a seat filler at the Oscars. That's really Cleveland's seat. I was there for one meeting. The committee acts on the through line of the data. And the through line of the data, you should not change what you think the through line is based on 1 month's number. But in the overall, you know that I believe that we are restrictive. I think that I've been saying for months that what we wanted to see was improvement on inflation and especially improvement in the components like housing and services. And we've been seeing that. And that the longer we were restrictive, we're going to have to start thinking about the employment side of the mandate.
Well, you've heard what the banks, economists, and traders are saying today. Should the next move in September be a 50 basis point cut? And what do you think about J.P. Morgan proposing, from a risk management perspective, there's a strong case to act before September 18th?
Look, Paul Volcker, my old mentor and friend, used to always, our job is to act and their job is to react. And let's not get the order mixed up on that. I fully understand why markets want to jump. If they get one scrap of information or they see one thing, they want to conclude a trend out of one data point. And I would just caution us, if we had acted at the end of 2023 based on a couple of observations, then the same people would have said, but look, inflation went back up in the first quarter, so that was a mistake. I think the most important thing is to look at the through line. What will determine the action is we don't want to tie our hands now. We're going to get a lot of information between now and the next meeting. And what will determine the size or if there is action at all will be the conditions. And that's the way it should be. That's, as I always say, the data dogs, there's a time for walking, there's a time for sniffing. The sniffing time is when there's a lot of uncertainty and you don't know what's what. Once you get the through line, that's the time for walking.
What exactly would it take to see a cut before that September meeting?
I'm not going to get in a speculative bit about that. The FOMC acts in a consensus manner. We have deliberation and debate, and we vote on things. And I try to bring the through line mentality of you don't take 1 month's number, look at what the trends are. And to me, the trends show inflation coming down across the board multiple months in a row. They show the labor market cooling. What we want is for the labor market to get into good balance, sort of the full employment natural rate. If we're not stopping at that, and then we're not neutral, and we're going to have to be thinking about the employment side of the mandate.
It's not just about the next cut. It's also about the path forward from here. For the people that think that you might get multiple half-point rate cuts through September, through November, through December, what do you tell them in terms of what to expect for the entirety of the path going into next year?
Look, I don't like tying our hands even for the next meeting, so I certainly don't want to commit ourselves to what's going to be the rate path 5-7 meetings from now. With all of that said, just look at the statement of economic projections, and you can see that as a committee, the individuals have believed that the conditions will be appropriate to have multiple rate cuts with the unemployment getting into better balance and with inflation coming down to target, but even at a run rate that's a little higher than what we've seen in the last couple of months. So it's not any secret. The Fed's been pretty vocal about here's what the reaction function is and expecting, as is historically true, when conditions warrant a cut, they tend not to be one individual cut. The SEP shows that the median dot of the dot plot has multiple cuts over the next year.
How weak is the U.S. economy overall? I want to point out something that your governor, J.B. Pritzker, the governor of Illinois, said just 2 days ago. Interest rates are holding companies back from making the investments that are necessary. All these companies are companies that are on a generally upward trajectory over the last decade, but are having a hard time in the moment because of some of the challenges the Federal Reserve has brought.
I mean, in a way, that's a description of monetary policy. That sounds like he's saying policy is restrictive, and I agree with him. When the real federal funds rate, that is the Fed funds rate minus inflation, that's as high as it's been in a very long time. That's the highest it's been over this cycle as inflation comes down. We set that rate a year ago at a time when conditions were very different than they are now. And you should be tightening by choice, not by accident. You shouldn't back yourself into tightening. What we need to do is take the through line on inflation and unemployment, and that's what should determine our policy. I don't want to argue about the words, how good or how weak is the economy. The numbers are the numbers. We've seen GDP growing around trend. We had one weaker than expected GDP growth number at the beginning of the year. Then we had a stronger than expected in the second quarter. And so we're growing, but it's slowing down. The strongest thing in the economy has been the job market. The weakest thing in the economy has been the inflation. Both of those are converging back to, let's call it normal or what it was pre-pandemic. And our absolute goal now is we want to settle at something like full employment, not blow through normal and deteriorate.
Well, I think the major thing that people want to know going forward is, now you mentioned all the data coming up. What are you going to be looking at? What are you going to base your interest rate decisions on?
I mean, for the dual mandate comes to us by law. The law says the primary things we got to look at are inflation and the job market, and are we maximizing employment? So those are going to be the big two kahunas as we go forward. But it is still an economy with cross currents, where you got some things that remain quite strong by historical terms and other things that have deteriorated. So if you look at credit card delinquencies or small business defaults, those have been rising, and they have moved into what I call warning sign stage. So I'm going to be looking at what Chair Powell calls the totality of the data, not just the monthly PCE inflation and jobs reports, but the PCE inflation and the jobs reports are the big two for sure by law.
We do have to leave it there. Wish we had more time, of course. That is Bloomberg's Michael McKee and Chicago Fed President Austan Goolsbee, off the heels of a very highly watched and surprising jobs report. We thank you both very much for your time. And up next, we're going to talk to Herr of JP Morgan and Steve Brown of Guggenheim to react to these market moves, very drastic, and of course, Austan Goolsbee's comments. Stick with us. That's all up next. This is Bloomberg.
We'd never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, you know that the market said maybe there would be 7 cuts for the year. And then when a month would come in, then that 7 would drop to 3. Then there was a group saying maybe there will be an increase in rates. The job of the central bank is to figure out the through line and to move in a steady way.
I'm Sonali, Basak, and this is Bloomberg Real Yield. And that was Chicago Fed President Austan Goolsbee speaking with us just moments ago. And here with us now is Herr of JP Morgan and Steve Brown of Guggenheim. And when you look over at JP Morgan right now, and it's aligned with Citigroup, this new call for that 50 basis point cut in September, another in November, maybe one even before September. How do you feel?
So hang on, I need to clarify. I'm from JP Morgan Asset Management, and so I think you're referring to Michael Feroli in our investment bank. A lot of respect for him, but that's actually not where we are. And I was struck by Austan Goolsbee's comments, because I never really thought about the similarities between Federal Reserve Governor and being a portfolio manager. So the sell side and the markets absolutely are going to react to what every single data point. But if you think about what Fed Chairman Powell said on Wednesday, or what Austan Goolsbee just said with you, they're looking at, I think he called it the through line, they're looking at the overall data, and we're doing the same thing. We're trying to manage portfolios and generate alpha for our clients and try to outperform our peers. We're not really trying to focus on what is today's action and what do we respond to that about?
Well, that's fascinating. Steve, how do you see the conundrum here? When you think about the moves in the market, not just today, frankly, this whole week, we'll talk about that more in a second, how do you think the market has reacted? Has it justified the moves that you're seeing?
Well, I think Kay brings up some great points. We like to take stock in the total picture, and as Mr. Goolsbee laid out, the Fed has been very data dependent and on a long-run trajectory for needing to validate certain data points for them to start to recalibrate policy, as they're calling it. So we've expected throughout the whole year that the Fed would be on hold, that eventually they would start easing, that there would be growing risks in the economy and the trajectory of economic growth. And so those risks are just becoming more to the forefront. And so now the two-sided nature of battling inflation and keeping the economy afloat are now skewed more towards downside risks in the economy, as we saw with the jobs report this morning. And so we think that brings the Fed closer to action. The most important point of the last week and a half, really, has been the pulling forward of interest rate cuts and then the deepening of the trough in the terminal rate. So seeing the terminal rate now closer to 3% is something we've been positioning for and something that we frankly think makes sense.
Put these moves into perspective, Kay, because you're looking at a 2-year yield alone that stood nearer to 4.40 at the beginning of the week. Now you're at 3.9%. Do these moves make sense?
So I think you need to take a step back and think about the market. And as I said, the market reacts to every single data point, whether it should or shouldn't. And I was struck by Mr. Goolsbee's comments, and it's something that we've noted as well. In the last 6 months alone, the market has been everywhere from the Fed's going to actually hike one time because the economy and inflation are reaccelerating, to the Fed's going to need to cut 6 to 7 times. You know, a year ago, if we'd been on this program, we would have said, oh my goodness, recession's coming. But if I look at our JP Morgan asset management perspective and how we've been managing portfolios, we have had a view that the U.S. economy is in a soft landing and the U.S. economy is going to stay in a soft landing. We absolutely acknowledge that that's an incredibly difficult thing for the Fed to accomplish, but that's where we think that they are. And our expectation really for probably about a year now has been that the Fed would cut 2 times this year in the back. So we try to think about managing portfolios and not getting too caught up in the daily moves. When I think about positioning portfolios, yes, we still like duration. I think we like duration. We also have interest in curve steepeners. So yes, we still find those attractive. But when we think about investing, we're looking about the fundamental, the quantitative, and the technical. In terms of the fundamentals today, yes, we absolutely see signs that the U.S. economy, the labor market is weakening. You know, Fed Chairman Powell referenced it on Wednesday. I think he correctly noted that the Fed increasingly is going to move away from thinking about focusing on inflation, which is decelerated by 150 basis points since the Fed stopped hiking a year ago, and focusing instead on the labor market. So they noted moderation in the labor market. They thought about the labor market coming into balance. What the markets, I think, for lack of a better expression, freaking out about today is that the labor market's not coming into balance, that the labor market is heading headfirst into a recession.
To that end, too, that data that we saw today, depending on how you round it, Steve, people are really worried about the triggering of the SOM rule, perhaps a greater play at a recession ahead. What is that risk in your view?
I mean, we've been flagging it as an above normal risk of a slowdown and potentially a recession, but it's not our base case, similar to Kay. Our base case is that we will continue to grow, potentially below trend of the last couple of years. But under the surface in the jobs report, as we've had a couple hours now, there's a little bit more mixed conclusions. It certainly was a weak report. And the greatest risk that we've been seeing has been the concentration in job gains to certain sectors over the last couple of months. So the broadening out of hiring has not been there. And so there's been a lot of focus on the SOM rule. I mean, in short, it really just says that when the unemployment rate rises by 0.5%, it tends to not stop there. So we're in danger zone, if you will, with employment. But as Mr. Goolsbee laid out, next month's release could change that trajectory a bit. I think what's important to us is acknowledging our risks one-sided or kind of more equally distributed, and what does that mean for policy and for rates? And so the moving forward of cuts, the deepening of the totality of cuts, we think makes sense and aligns with how we're positioned.
I feel like we need to do the very annoying thing here and just talk about the risks still ahead for the next couple months. You have, for example, the election coming up. A lot of concerns about potential inflationary forces ahead under whatever president might take the office in November. How do you think about this drastic move and the risk that perhaps this market has gone a little too far?
So, Sonali, I mean, that's what we're dealing with every single day, basically, right? You talk about big, yes, this was absolutely a big economic debate, but you know what? Next week, we've got ISM services. We've got data every single week. And you're right, increasingly, we are going to get more and more information about the election. And it seems unlikely that, or it seems likely that either candidate was successful may well be inflationary. But I think the more immediate concern is absolutely the risk to the downside in inflation. We continue to maintain that our base case is soft landing, and that is our position.
Only about 30 seconds left for each of you. Where do you think the 10-year ends next year?
So this year we kind of think 3.75 to 4.25. I think next year is really a function on whether the Fed gets ahead and is able to maintain a soft landing, or whether we do in fact slip in a recession. And I think the risk therefore would be skewed to the downside next year.
Steve, 10 seconds. 10-year at the end of 2025.
At the end of 25, in the mid to high threes, we expect an upward sloping yield curve and a normalization of yields going from, call it low threes, upwards to 4 as you go out the yield curve.
That curve steepening trade still in full play. That is Herr of JP Morgan and Steve Brown of Guggenheim. Thank you both for joining us, of course, on a very busy day of economic news. Happy Friday to both of you. Now, still ahead, the final spread, the week ahead, economic data and earnings season still in full swing. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield, and it's time now for the final spread, the week ahead. Coming up, we're going to hear on Monday from San Francisco Fed President Mary Daly, plus we'll get U.S. PMIs and ISM services. Tuesday, U.S. trade balance figures and earnings from Uber, Reddit, and Airbnb. Wednesday, more earnings from Disney and Lyft, plus U.S. consumer credit data. I'm looking forward to that. Finally, Friday, we'll get China and Europe CPI numbers. And for my final thought, I want to look at those wild market moves, because if you think the VIX is flying, so is the MOVE Index. We're taking a look here at just how much volatility is seeping right back into markets. And of course, on the MOVE, we are back above 100 handle, and on the VIX, well above that 25 handle. That sets up for a very interesting week ahead. From New York today, though, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.